Trump economy on a path to crash like 1929. Could today's economy under Donald Trump be heading toward a crash reminiscent of 1929? The stock market is at record highs, investor optimism is palpable, and debt levels continue to climb. Some historians say the echoes of the Roaring Twenties are visible, a society confident in endless growth, banks full of leverage, and ordinary people chasing wealth with borrowed money. In 1929, this optimism turned into panic overnight. Could history repeat itself? This documentary examines the facts, compares the eras, and explores what makes the economy fragile and what makes it resilient. In this documentary, we'll examine the Trump-era economy through 16 lenses, from the roaring optimism of today's markets to the silent risks beneath them. We'll compare the mechanics of past crashes, explore speculation then and now, dissect debt, trade tensions, employment trends, and the tools central banks now wield. We'll revisit the stories of families who lost everything in 1929 and hear how modern America might avoid the same fate. Historical echoes, how the Roaring Twenties optimism and speculation resembled today's market highs. Modern comparisons, what makes the Trump-era economy unique and where parallels to 1929 emerge. Crash mechanics, how overvaluation, leverage, and fragile confidence can trigger market collapses. Separating fear from reality, distinguishing media speculation from actual economic risk. Human stories of the 1920s, personal accounts of families and investors affected by speculation. The 1929 crash, how Black Thursday and Black Tuesday unfolded, triggering the Great Depression. Trump-era optimism and risk, record highs, corporate growth, low unemployment, and rising debt. Speculation then versus now, comparing margin trading in 1929 to modern tech, crypto, and high-risk assets. Trade and global impact, lessons from Smoot-Hawley and today's tariffs and trade tensions. Debt and financial stability, comparing fragile banks of 1929 with modern financial institutions and corporate debt. Employment and growth buffers, labor market resilience versus potential localized shocks. Policy tools and safety nets, how central banks and fiscal policy act as modern stabilizers. Emerging risks in 2025, high valuations, trade conflicts, inflation, and geopolitical uncertainty. Lessons from history, recognizing warning signs and understanding how speculation and debt can cascade. Preventive measures, what policymakers and citizens can do to reduce the chance of a crash. Conclusion, synthesizing history, modern safeguards, and vulnerabilities to understand whether a 1929-style collapse is likely. By the end of this journey, viewers will have a clear 360-degree view of the Trump-era economy, informed by history, human stories, and economic analysis, giving a grounded sense of risk and resilience. Because history doesn't repeat itself, but its shadows never truly disappear. In the autumn of 1929, America's dream economy unraveled overnight. Black Thursday, panic hit Wall Street. By Black Tuesday, the illusion of endless prosperity shattered. Billions in wealth vanished. Banks failed. Families lost everything. Factories went silent, and unemployment soared beyond 20%. But the real collapse wasn't just financial, it was psychological. As economist John Kenneth Galbraith later wrote, the crash was not just financial, it was a loss of faith. Confidence vanished, and with it, the belief that the system could protect the average American. Almost a century later, echoes of that moment linger. In 2025, markets again hover near record highs, not driven by production, but by debt-fueled optimism. Household debt exceeds $17 trillion. Corporate borrowing has never been higher. Investors chase speculative assets, AI startups, crypto rebounds, meme stocks, fueled by the belief that tomorrow will always rise higher. Just like in 1929, confidence feels unbreakable, until it isn't. Back then, radio and real estate were the craze. Today, it's technology and artificial intelligence. The foundation in both eras rests on leverage, speculation, and faith, fragile ingredients for lasting prosperity. And once again, one unexpected shock could make that tower of optimism crumble. Donald Trump entered office promising to restore American greatness through growth. And for a time, the numbers glowed. Stock markets soared, unemployment hit record lows, and optimism flooded across boardrooms and living rooms alike. But beneath that success, the cracks were already spreading. Corporate tax cuts spurred massive stock buybacks instead of real investment. Manufacturing jobs saw brief gains, then reversed as tariffs raised import costs. Debt became the silent engine of expansion and the silent threat behind it. By 2019, corporate debt had surpassed $10 trillion. Consumers, boosted by low interest rates, borrowed freely. Then the pandemic struck. Stimulus money poured in, cushioning the fall, but adding trillions more in national debt. The short-term rescue became a long-term burden. By 2025, inflation cooled but never truly vanished. The stock market once again touches historic highs, yet millions face rising rents and shrinking savings. It's prosperity on paper, pressure in reality. Just like the Roaring Twenties, when glittering wealth masked a fragile base, Trump-era growth built its image on perception, not resilience. Speculation has always been America's favorite illusion. In the 1920s, taxi drivers traded stocks. Housewives passed investment tips over coffee. Everyone believed they could get rich. Few asked whether the stocks were worth anything at all. Nearly a century later, the pattern repeats. Only this time, it's online. In 2025, trading happens through apps, influencers, and viral videos. People invest not in companies, but in trends. Greed and FOMO drive billions into assets that exist only on screens. Back then, the stars were RCA and General Motors. Today, it's Tesla, Nvidia, and a dozen AI startups valued higher than established giants. Margin trading and easy credit push prices skyward. The same old story, easy money-making risk, look invisible. Both eras shared the same mantra. This time is different. But history never changes its script for long. Speculation ends not with a whisper, but a trigger, a moment when belief finally meets math. In 1929, that trigger was tightening credit. In 2025, it could come from inflation spikes, debt defaults, or an external shock that reminds the market how fragile it truly is. Every age of prosperity runs on credit, and credit always has a limit. In 1929, brokers offered buy now, pay later stock margins to anyone with a dream. Banks extended reckless loans, trusting prices would never fall. When they did, the collapse was instant. Margin calls erased fortunes, homes, and hope in days. Today the faces have changed, but the addiction remains. Corporate America owes over $13 trillion. Federal debt exceeds $38 trillion, the highest in history. Consumers, facing rising prices, lean on credit cards just to survive the month. Debt fuels consumption, inflates markets, and sustains the illusion of prosperity. But as interest rates rise and growth slows, that illusion begins to strain. In the 1920s, banks were the weak link. In 2025, the pressure lies with shadow lenders, private equity firms, and leveraged tech giants. Different names, same fragility. History shows that when debt becomes the driver instead of the tool, collapse isn't a possibility. It's an equation waiting to balance itself. And the danger isn't always sudden. It begins quietly, with confidence. The same confidence that once made 1929 seem unstoppable. Trade wars are never just about tariffs. They're about trust. In the late 1920s, the Smoot-Hawley Tariff Act sought to protect American farmers and manufacturers. Instead, it strangled global trade. Retaliation came swiftly, and exports collapsed by over 60%. The world's economies, already fragile, fell together. Nearly a century later, history rhymes. In the Trump years, tariffs on Chinese steel, aluminum, and electronics returned the U.S. to a protectionist path. At first, it sounded patriotic. America first. But global supply chains don't bend to politics. Prices rose, small manufacturers felt the squeeze, and farmers faced retaliation from Beijing. A soybean farmer in Iowa once put it simply, the tariffs didn't kill us, they just made everything harder. By 2025, the aftershocks linger. Trade flows have shifted, but not necessarily improved. China, Russia, and BRICS partners have built alternate trade routes and reserve systems, slowly reducing reliance on the dollar. Just like the 1930s, when economic isolation deepened the depression, today's fragmented trade landscape tests the strength of globalization itself. The world now sits in a balance between cooperation and competition, between shared prosperity and national pride. And history reminds us, every time nations turn inward, economies turn fragile. Inflation, the invisible tax, is another ghost of the past returning. In the early 1930s, prices didn't rise, they collapsed. But by the mid-2020s, the world faces the opposite threat. Inflation eroding purchasing power, quietly eating away at savings. In 2021, stimulus checks and record low rates sparked a spending boom. By 2022, that boom became a burn. Prices climbed. The Federal Reserve raised rates to cool the fire, but at a cost, higher borrowing expenses for everyone. A home that cost $400,000 2 years ago now costs $3,000 more per month to finance. And while official inflation has slowed, real-world inflation, housing, food, healthcare, remains stubbornly high. Economists call this the sticky decade, a period where prices no longer fall easily and growth slows under the weight of debt and policy. It's not a crash yet, but it's friction, the kind that wears confidence thin. Confidence, and the one element no chart can measure, was what vanished first in 1929. The same risk hovers now. When markets rise purely on belief and people stop asking why, the stage is set. In both 1929 and 2025, optimism was the fuel, but unchecked optimism can be as dangerous as fear. The difference is that today we have more tools. Central banks can inject liquidity with a click. Fiscal policy can target sectors instantly. Social safety nets cushion the blow for millions, yet even these safeguards depend on trust. Trust that policymakers act swiftly, that governments manage debt responsibly, that investors keep believing in the system. But confidence once shaken spreads faster than any virus. In 2008, it took a single bank, Lehman Brothers, to shatter global faith. In 1929, it took a few bad trading days. In 2025, it might take a data leak, a default, or an algorithmic panic in a market driven by machines, not men. Still, resilience exists. America's labor market, diverse, flexible, and adaptive, remains a buffer. New industries in clean energy, AI, and automation drive productivity. But that same automation replaces human jobs, widening inequality, a quiet tension beneath the numbers. In 1929, 1 in 4 Americans lost work. Today, millions could lose relevance instead, displaced not by collapse but by code. This is the paradox of modern progress. The system grows stronger, even as individuals feel weaker. Technology lifts markets but leaves many behind. It's prosperity without stability, growth without guarantee. And that brings us to the core of it all. Debt, speculation, policy, and human behavior, all woven into a cycle that has played out for centuries. Rome, Britain, 1929, America. Each believed it had mastered risk. Each believed it was too advanced to fall. Each forgot that what collapses empires and economies alike isn't always external. It is the silent erosion of restraint. As America moves deeper into this new age of data-driven finance and political division, the real question is no longer if history will repeat, but how much it will rhyme. Debt has always been America's silent engine, and its greatest risk. In 1929, it was margin loans and speculative credit. In 2025, it's corporate leverage, consumer borrowing, and the federal deficit surpassing $38 trillion. On paper, the system holds low defaults, strong GDP, and stable unemployment. But beneath, a debt pyramid grows taller each year. Corporations refinance old loans with new ones. Households rely on credit cards to offset inflation, and the government funds trillion-dollar deficits through bonds that foreign buyers are slowly losing appetite for. China and Japan, once top holders of U.S. treasuries, are quietly reducing exposure. That's the quiet shift, not a crash, but a recalibration of faith. The dollar's dominance, long unquestioned, now faces subtle erosion. And faith, once lost in markets or currency, takes years to rebuild. It is not that America is collapsing, it is that it is aging into a more fragile form of prosperity. In 1929, bank failures toppled communities. Today, the banking system is fortified, yet trust remains its oxygen. If confidence in the dollar falters, it won't happen overnight. It will fade quietly, one policy mistake at a time. Meanwhile, employment, the human measure of economic health, remains the strongest shield. In the late 1920s, factories ran at full tilt. So did America in the Trump era. But automation, outsourcing, and digitization now reshape the meaning of work. A single algorithm can replace hundreds of clerks. A robot can replace a production line. The new risk isn't unemployment, it's underemployment, a workforce running but no longer rising. Still, there's resilience. Small businesses, freelancers, and new digital entrepreneurs adapt faster than any generation before them. The spirit of innovation remains America's greatest hedge against collapse. But innovation without inclusion deepens divides. And in economics, division always precedes decline. The government's arsenal today dwarfs what existed in 1929. The Federal Reserve can adjust interest rates within minutes. Liquidity injections can stabilize markets before panic spreads. Unemployment insurance, food programs, and stimulus checks act as safety nets the Great Depression never had. But even the best tools have limits. You can't print confidence, you can't legislate optimism, and you can't algorithmically manage fear. Former Fed Chair Janet Yellen once said, "Policy can prevent panic, but not human behavior." That remains true. Our safeguards protect the system, but not the psyche that drives it. In every crash, 1929, 2000, 2008, emotion always arrived before logic. So what are the signs now? High valuations, elevated debt, slowing trade, persistent inflation, and political polarization. No single factor guarantees a crash, but together they create vulnerability. The question isn't whether America will fall, it's whether it can bend without breaking. History offers lessons if we care to listen. Speculation without restraint, debt without discipline, optimism without realism. These were the pillars of 1929. They are visible again, though muted by modern complexity. Preventing another collapse doesn't require perfection, it requires humility. The willingness to act before euphoria blinds judgment. That means clearer regulation on high-risk lending. Balanced trade policy that protects without isolating. Transparency in financial markets. Education for investors and prudence from policymakers. Because prevention is always cheaper than rescue. Ultimately, this isn't a story of doom, it's one of awareness. The Trump-era economy, like the 1920s, is a study in contrasts, prosperity and peril, innovation and imbalance, faith and fragility. The tools we have today are stronger, but the psychology that drives markets hasn't changed. Human optimism still fuels growth, and human fear still ends it. Perhaps the real shadow of 1929 isn't the crash itself, but the complacency that preceded it. The belief that it can't happen again because it can, not in the same way but through the same habits, excess, denial, and delay. So is the Trump economy on a path to crash? Not necessarily, but it stands at a crossroads between vigilance and vanity. If history teaches anything, it's this. Prosperity survives not through power, but through restraint. And civilizations fall not when they run out of money, but when they run out of wisdom. Because in the end, economies aren't built on numbers, they're built on trust. And trust, once lost, becomes the most expensive thing to rebuild. The Trump-era economy shares unmistakable echoes with 1929, elevated markets, trade pressures, and rising debt. But the world has changed. Today's system is stronger, faster, and more deeply connected than anything the world of 1929 could imagine. Banks are insured, markets are monitored. Central banks can inject liquidity at the tap of a keyboard. Yet beneath those safeguards lies something timeless, human emotion, fear, greed, overconfidence. The same forces that fueled the Roaring Twenties still move the levers of modern finance. The difference between 1929 and today is not just policy, it's awareness. We have the data, the tools, and the historical memory to recognize when risk turns to recklessness, But awareness is useless without discipline. The lesson of 1929 isn't that prosperity is dangerous. It's that unchecked optimism blinds nations to fragility. The same energy that drives innovation, investment, and ambition can, if left unbalanced, tilt into excess. The next downturn, whether tomorrow or 10 years from now, will test not just America's markets, but its judgment. Can a society addicted to growth rediscover the value of restraint? Can policymakers act before confidence collapses, not after? History never truly repeats, but its shadows remain. And if we fail to read them, the price of forgetting may once again be measured not in numbers, but in lives disrupted and dreams erased. Because in the end, every economic era, from 1929 to 2025, answers the same timeless question: what holds more power, human wisdom or human habit? All data and sources used in this video are verified. Full reference links are available in the video description.